Assalamualaikum warahmatullahi wabarakatuh. Hello everyone, my name is Putri Oktaviani. I'm from Economic Education in Universitas Negeri Padang. And now I will explain the material about monetary economics. Check this out. Interest rate as monetary economic instruments, loan interest rates, and installment amount. First, understanding interest rate. According to Classic and Keynes, interest rates according to Classic and Keynes, classical theory. The theory of interest of supply and demand for saving. This theory discussed the interest rate as balancing factor between demand and supply, rather than investable funds originating from saving. And Keynesian theory. Keynes' theory of interest rate determination is known as the theory of liquidity preference. Keynes said that the interest rate is solely a monetary phenomenon whose formation occurs in the money market. In Keynes' theory, there are three motives that underlie people's money demand, namely transaction needs or transaction motive. Namely, the motive for holding money for daily transaction needs. The amount of money for this purpose depends on the amount of income. The need of preoccupations, namely the motive for holding money because of uncertainty about the future. The need for speculation, that is the motive of holding money for speculative purposes and profit seeking as a precautionary motive. The motive for the demand for money for the speculation arises due to uncertainty in the future. Second, definition of nominal and real interest rates. Nominal interest rates. The nominal interest rate is the interest rates in the value of money. This interest rate is a value that can be read in general. This interest rate shows the number of rupiah for every one rupiah invested. This interest rate is the interest rate charged on the loan. And real interest rate. Real interest rate is the nominal rate minus inflations. In other words, this is the rate the lender will expect after accounting for inflation. The real interest rate is the actual returns generated by borrowed or lent funds. And next is calculating nominal and real interest rates. So, nominal interest rate is R multiply N equals R multiply M plus R multiply P plus RT and R plus multiply I. And real interest rate is RR is equals R multiply N minus R multiply I. And understanding and factor of affecting on bank rates. First is fund requirements. First, funds requirements. If the bank lacks funds or deposits lacks an application increase, then what the bank does artificially by increasing the deposit will attract customers to save money in the bank. Fund requirements. Second, competition. Third, government policy. Fourth, decide profit. Fifth, terms. And then is quality guarantee. 7, company reputations, competitive products, good relationship, and the last is third party guarantee. And that's all of my explanations about monetary economics. With the title interest rate as a monetary economic instruments, loan interest rates and installment amount. Thanks for your attention, guys. See you in the next video. Assalamualaikum warahmatullahi wabarakatuh. Dadah.